Hey everyone, welcome back to Corporate Decoder. Today, PDS Biotechnology just filed a current report on Form 8K, and I am seeing a big shift in their financing strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is bringing in new money, but it comes with some interesting strings attached. Alright, let's dive into what PDS Biotechnology Corporation, or PDSB as you know them, has just announced they've entered into a new agreement that is pretty significant for their financial future. Think of it as a new deal to get funds that will keep their operations running and their research moving forward. So the core of this filing is about a Securities Purchase Agreement. Basically, the company PDS Biotechnology Corporation is making a deal with an investor, the Serpien Ltd. This isn't just a small loan, it is a substantial financial arrangement. They're agreeing to issue and sell not just one thing, but two important financial instruments to this investor. First, they are issuing a promissory note, which is essentially an IOU for a principal amount of $6 million. That is a lot of money, and it means the company is taking on significant debt. Second, as part of this deal, they're also giving the investor a warrant. Now, a warrant is like a coupon that gives the holder the right to buy shares of the company's stock at a set price in the future. In this case, it is for nearly 2.2 million shares at $1.1824 per S-share. This gives the investor a way to profit if the company's stock price goes up significantly. The closing date for this whole transaction is expected around the 12th of June 2026. But before that happens, there are a bunch of conditions that need to be met. These are standard things like making sure all the paperwork is in order, promises made by both sides are true, and that neither company is in a bad financial spot. They need to make sure that PDSB stock is still trading on the Nasdaq stock market, which is a good sign they intend to stay listed. The agreement also has some pretty standard clauses about what PDSB can and cannot do. For instance, they have ongoing promises called covenants, and if they break them, there can be consequences. A key restriction is that while the promissory note is outstanding, PDSB and its subsidiaries can't take on new debt or pledge their assets as collateral for new loans, unless it is for something they consider permitted indebtedness or permitted liens, which are defined within the agreement itself. Another really interesting part here is the restriction on variable rate transactions. They're basically saying they can't enter into deals where the price of securities can be reset based on the stock's trading price or other fluctuating market conditions. This is a way to prevent them from getting into situations where they might issue stock at a price that keeps going down as their stock price falls, which is what happened to some companies in the past. The main exception to this rule is at the market offerings, which we will get to later. The entire deal needs to be finalized by the 15th of June 2026, unless both sides agree to extend it. Let's talk more about this $6 million promissory note. It is being issued on the closing date, but the company is only receiving $5,760,000 for it. This means there is an immediate discount, which is common in these types of financing deals. The note matures in 12 months from the closing date, and it carries a 10% interest rate. This interest rate can go up if certain events of default happen, which are basically conditions that indicate the company is in trouble. Interest payments are due monthly starting about 2 months after the closing. The company does have the option to pay back this note early, either in full or in part, without any penalty. But here is where it gets a bit more complex. The investor can also push for accelerated payments. Starting in September 2026, the investor can ask for up to $1,600,000 in extra principal payments. There is a limit on how much each monthly payment can be increased, which is $700,000. Now, this is a key point. The company has agreed to use a portion of the money it gets from selling its stock through an the market program that we'll discuss, to pay down this promissory note. Specifically, 100% of the net cash proceeds from those stock sales will go towards the next principal payment due. If those proceeds are more than what is needed for that payment, 60% of the leftover cash will be used for future payments, and the company can keep the remaining 40%. This is a way for the investor to ensure they get their money back relatively quickly, especially if the company starts selling a lot of stock. Then there is the conversion option for the investor. If the company fails to pay amounts owed under the note on time, the investor can choose to convert the unpaid portion into PDSB's common stock. The conversion price is based on the stock's trading price, but it is at a discount. It is either 95% of the lowest average trading price over 5 days, or 92% of the previous day's closing price. Importantly, this conversion price cannot be lower than 20% of a price defined as the minimum price under $5,635 on the closing date. This is a critical protection for the investor, ensuring they get a base value even if the stock price plummets. There are also limits on how much stock the investor can end up owning through these conversions. They can't exceed 4.99% of the company's outstanding stock after conversion, unless they get shareholder approval. Also, the total number of shares they can get through conversion is capped at 19.99% of the company's stock outstanding as of the agreement date, unless they get more shareholder approval. These are important safeguards to prevent massive dilution of existing shareholders. And just to reiterate, the company is generally restricted from making any deals that would interfere with its ability to pay back this note, or from changing its core documents in a way that harms the investor's rights. The note also includes typical default clauses related to things like bankruptcy. To make sure the investor feels secure, PDS Biotechnology Corporation's wholly owned subsidiary, PDS Operating Corporation, has signed a guarantee agreement. This means the subsidiary is making itself responsible for all of PDSB's obligations under the purchase agreement and the promissory note. It adds another layer of security for the investor, knowing that not just the parent company, but also a key subsidiary is on the hook. Now about that warrant, it will be issued on the closing date and will become exercisable 6 months after that date, and it will be good for 5 years. The exercise price is $1.1824 per S-share. Just like we mentioned when we first talked about the purchase agreement, there are adjustments for things like stock splits and dividends in the warrant itself, which is pretty standard. Similar to the promissory note, there are limits on how much stock the investor can acquire through exercising this warrant. They can't end up owning more than 4.99% of the company's outstanding shares immediately after exercising unless shareholder approval is obtained. And the total number of shares issuable upon exercise is also capped at 19.99% of the company's stock outstanding as of the agreement date. Again, unless shareholders vote to allow more. These are designed to prevent overwhelming dilution. A really interesting wrinkle is what happens if there isn't an effective registration statement for the shares when the investor wants to exercise the warrant. Instead of paying cash, the investor can choose to receive shares directly on a cashless basis. They'll get a net number of shares calculated using a specific formula outlined in the warrant. This is a common feature that allows investors to get their holdings without needing to come up with more cash upfront. Following this deal, PDSB and the investor will sign a registration rights agreement. This means PDSB is obligated to file a registration statement with the Securities and Exchange Commission to register the shares that could be issued from the promissory note and the warrant. They have 30 days from the closing date to file this. If they miss this deadline or fail to keep the registration statement effective, they're considered in default under the promissory note. This is a pretty strict requirement to ensure the shares can be legally traded by the investor. PDSB also agreed to cover liabilities related to selling these shares and to handle all the associated fees. In addition to all of this, and this is important for how they might raise more money going forward, the company is also entering into a sales agreement with Yorkville Securities, LLC. This sets up an at-the-market offering program. Essentially, PDSB can choose to sell shares of its common stock through this agent from time to time, whenever it wants, and at its discretion. These shares will be sold through the Nasdaq stock market or other trading venues. The company will pay the sales agent a commission of 3% of the gross sales proceeds. They've also provided the agent with standard indemnification rights, meaning the agent is protected from certain liabilities. It is crucial to note that PDSB is not obligated to sell any shares through this agreement. The program will end when all the shares are sold or when the agreement is terminated. This is a way for the company to raise capital relatively quickly and efficiently by selling stock directly into the market. The document mentions that the descriptions of these agreements are not the whole story and that the full details will be filed as exhibits in their next quarterly report. Now, shifting gears slightly, this filing also mentions the termination of some older agreements. On the same day, PDSB sent out notices to prepay all outstanding principal on their senior secured convertible debentures. These debentures were issued back in April 2025. The company plans to pay back 103% of the principal amount outstanding, plus all accrued interest on the 12th of June 2026. Once this payment is made, these debentures will be fully redeemed and will no longer be in effect. Additionally, an agreement from August 2024 called the Prior Sales Agreement, which involved different agents, has been terminated. The company and the agents agreed to end this arrangement, effective immediately on May 1, 2026. This suggests they are consolidating their financing arrangements and moving to the new sales agreement we just discussed. The details about the new financial obligations, like the promissory note and warrant, are already covered under Item 1.01. so there is no new information here in this section. Similarly, the information about the issuance of the promissory note and warrant is also found in item 1.01. The filing notes that these issuances are exempt from registration under securities laws because they are being sold under specific exemptions like Section 4 and Regulation D, which are typically used for private placements. And finally, the report is signed by Frank Baidu Adu, PhD, the President and Chief Executive Officer, on May 1, 2026. Looking at this filing, PDS Biotechnology is clearly prioritizing raising capital to fund its operations. The new $6 million promissory note and warrant deal with Yati PN Ltd provides them with immediate funds, but it also comes with potential dilution through the warrant and conversion features if the stock price doesn't perform well. The fact that they are using proceeds from future stock sales to pay down this note is a significant commitment. This move away from the older debentures and sales agreement signals a strategic shift towards a more consolidated financing approach. The key risk here is the speed at which they might have to issue shares at potentially unfavorable prices if they need to raise more capital, or if the note conversion is triggered. The inclusion of the new market offering agreement with Yorkville Securities is their primary tool for flexibility moving forward. My biggest concern is how the market will react to the potential for future dilution from both the warrant and the market program. What I am actually looking for is how they will manage their cash burn rate and the effectiveness of their drug development pipeline moving forward to justify any potential dilution. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.